The global financial system is entering a new phase in which capital allocation, debt sustainability, and monetary power matter far more than short-term market movements. While most investors focus on daily price fluctuations, the real financial decisions shaping the future are being made quietly at the strategic level. Governments, central banks, and institutional investors are repositioning capital in response to long-term structural pressures rather than immediate economic headlines. This shift represents a fundamental transformation in how financial power is exercised and preserved. Strategic finance is no longer about maximizing short-term returns, but about controlling stability, liquidity, and systemic influence. The first signal of this change appears in how central banks now think about interest rates, balance sheets, and long-term credibility. After decades of cheap money, the global economy is adjusting to a reality where capital has a real cost again. Higher interest rates are not merely a tool to fight inflation, but a mechanism that redistributes financial power across sectors and countries. Nations with strong balance sheets gain flexibility, while highly leveraged economies lose strategic options. This dynamic is quietly reshaping global capital flows. Investors are increasingly differentiating between productive debt and structurally unsustainable debt. Sovereign debt is no longer treated as uniformly risk-free, but as a strategic variable that depends on fiscal discipline and political stability. Bond markets have become a real-time referendum on government credibility. When yields rise sharply, they signal more than inflation expectations. They reveal doubts about long-term financial management. Strategic investors are responding by reallocating capital toward economies with predictable policy frameworks. This explains why some currencies remain resilient despite global uncertainty. Monetary power today is defined not only by currency dominance, but by confidence in institutional discipline. The US dollar remains central, yet its role is increasingly challenged by fragmentation rather than direct competition. Instead of a single alternative reserve currency, the system is evolving toward a multipolar financial structure. In this environment, capital diversification becomes a strategic necessity rather than a tactical choice. Central banks are adjusting reserve strategies to reflect geopolitical and financial risk. Gold, once viewed as a relic, has re-emerged as a strategic hedge against systemic instability. Energy assets and critical commodities are increasingly treated as financial instruments rather than purely industrial inputs. Strategic finance recognizes that real assets anchor monetary systems during periods of uncertainty. This is why infrastructure, energy networks, and supply chains now attract long-term institutional capital. Pension funds and sovereign wealth funds are extending investment horizons rather than shortening them. Liquidity is being valued not just for return generation, but for resilience under stress. Financial stability now depends on the ability to absorb shocks rather than eliminate volatility. Debt sustainability has become a strategic constraint on national policy. Countries burdened by excessive debt face limited responses during economic downturns. Strategic finance emphasizes flexibility over leverage. This shift is changing how fiscal policy is designed and communicated. Governments increasingly signal long-term discipline to maintain market access. Markets reward consistency more than ambition. Inflation risk has permanently altered how capital is priced. Investors now demand compensation, not only for growth risk, but for policy uncertainty. Strategic capital flows away from unpredictable environments. This creates a reinforcing cycle where stability attracts investment and instability accelerates capital flight. Financial power is therefore becoming more concentrated. Technology amplifies these dynamics by accelerating information and reaction speeds. Algorithmic trading magnifies market responses to policy signals. This forces policymakers to think strategically rather than tactically. Short-term interventions now carry long-term consequences. Strategic finance requires patience in a world obsessed with immediacy. The role of central banks has expanded beyond inflation control into systemic risk management. Balance sheet decisions are now political as well as economic. This blurs the line between monetary policy and fiscal responsibility. Markets are increasingly sensitive to credibility rather than promises. Financial communication has become a strategic tool. Small policy missteps can trigger outsized market reactions. This environment rewards transparency and consistency. Strategic investors look beyond GDP growth to institutional strength. Legal frameworks, governance quality, and demographic trends now influence capital allocation. Financial resilience is becoming more important than rapid expansion. This marks a shift away from debt-fueled growth models. Countries that fail to adapt risk structural decline rather than cyclical slowdown. Strategic finance also reshapes corporate behavior. Companies are prioritizing balance sheet strength over aggressive expansion. Access to capital increasingly depends on perceived long-term viability. Credit markets now punish excessive leverage more quickly. Strategic risk management has become a competitive advantage. The global economy is transitioning from a growth-at-any-cost model to a stability-focused framework. This transition is uneven and politically sensitive. Social expectations collide with financial constraints. Strategic finance recognizes that economic credibility underpins political legitimacy. Nations unable to finance their promises lose influence. This reality shapes geopolitical relationships as much as military power. Financial leverage has become a tool of influence and pressure. Capital access now reflects alignment, stability, and trust. Strategic finance therefore operates at the intersection of economics and geopolitics. The next phase of global competition will be fought through financial architecture rather than direct confrontation. Debt, capital flows, and monetary credibility will determine winners and losers. Investors who understand this framework position themselves ahead of cycles. Short-term noise distracts from long-term structure. Strategic finance rewards discipline, patience, and realism. This is why long-term capital increasingly avoids speculative excess. Volatility is no longer the primary risk. Structural fragility is. Financial systems survive by adapting, not by expanding endlessly. The era of unlimited liquidity has ended. What replaces it is a system defined by constraints. Strategic finance is the discipline of navigating those constraints intelligently. It requires understanding debt, currency credibility, and institutional strength simultaneously. Markets will continue to fluctuate, but structure determines direction. Those who focus only on prices miss the deeper transformation underway. Financial power now belongs to those who control stability rather than speculation. This shift explains many seemingly disconnected economic events. Strategic finance reveals the logic behind capital movement. It clarifies why some economies attract investment while others struggle. The future of finance will be quieter, more disciplined, and more selective. Excess will be punished faster. Credibility will be rewarded more consistently. Financial strategy will matter more than financial optimism. Investors must adapt to this reality. Policymakers must respect it. Institutions must be built around it. Strategic finance is not a trend. It is a structural evolution of the global economy. Understanding it is no longer optional for serious market participants. It is the framework through which the next era of global financial power will be defined.